Hi, I'm Glenn Royal, Chief Investment Officer and Partner at RHP Wealth Management. Welcome to this month's Market Minute. I want to talk to you a little bit about something that's getting all of our attention, and that's the bond market. We've seen yields increase towards that all important 5% level, roughly at 4.75 now. And a lot of this has been a result of things that have happened since December. In the middle of December, we had a Federal Reserve meet and do one final quarter point cut in the interest rate cycle. That took us down 1% for 2024 in federal funds rate. However, what is a little bit odd in this cycle is that we've actually seen the 10-year Treasury yield increase by 1%. It's unusual to see Fed funds go into a cutting rate cycle and see interest rates actually go higher. So, what does that mean? Well, there's still a little bit to be determined exactly what that means, but in the short run, we think there's a little bit of concerns related to potential for tariffs and other policies that may create a little bit of inflation. We're not just seeing the increase in interest rates here in the US, we're also seeing that worldwide. So that gives us a little more confidence that investors are concerned about the incoming administration's policies. That being said, one of the things that higher interest rates does, besides affect valuation of the stock and the growth rate of the future stock, it also makes alternatives more attractive. In this case, we think bonds are the alternative asset right now for equities. The 60 portfolio, 40 portfolio is alive and well, the old balanced portfolio. I think that having 40% of your allocation in fixed income with a good chunk of that snugged up into the shorter maturities to just kind of wait and see until this blows over, until we have greater certainty about policy is a good place to be right now. We are entering the fourth quarter earnings. It begins this week. We'll see all the companies in the S&P 500 report how they did in that fourth quarter. And one of the drivers for stock prices, higher growth rates. That is expected to come through this year. We're looking for roughly 12% growth in earnings for the S&P 500, and that will begin with roughly 7% expectations in this first quarter. These are lofty levels to reach at a time where you have high valuations. So don't be surprised if you get a little bit of indigestion here and there. Those companies that meet or beat estimates can see a little bit of price volatility as we get through this earnings period. While bonds are offering us some value in the short end, and we like those great deal getting us over 5%, we're seeing in those cases, which is 2% above inflation and a very attractive real rate. I think that the equity game is not over yet. You still have a market that's going to be looking at deregulation and tax cuts and earnings growth fueled by these policies. So we'll have to see how the year goes. But starting right now, out of the gate for the month of January, we have the bond market that we need to contend with. I want to encourage you, if you have any questions or concerns about this video or comments, please reach out to any member of the team here at RHP. We're happy to work with you and help you understand what's happening today in financial markets. As always, it's great to see you, and we look forward to next time. Have a good day.